Good morning and welcome to the SLEEP PLC trading update for the full year investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Just simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. And now I'd like to hand you over to Cheryl Calverley, CEO, and Tim Parfitt, CFO. Good morning to you both.
Morning. Thanks, Alexandro. Welcome and thanks to everyone for joining the call. I hope you've had a chance to review the trading update that I released this morning. Here today you've got myself, Cheryl, the CEO, and we have Tim Parfitt next to me, CFO.
Morning.
This is a trading update. So the main purpose of this call is to give you guys a chance to ask the questions. I know that we've got a very broad investor base with lots of questions, and it's a chance to sort of ask those questions in a live manner. First of all, I'm just going to provide a brief summary of the year, which is a little combination of what you've seen probably across the trading updates in the year, and will obviously come together more fully in our annual results in March-ish. You should also know that the rebuild strategy is now successfully implemented and the benefits are starting to come through. So we are beginning to plan to step up our level and frequency of investor communications. That I think will help people understand a little more about where we're trying to take the business at each turn as we sort of become a little more proactive. Our final results are scheduled for the 24th of March. Apologies, I should have said that earlier. And we'll hold another investor call there, again through Investor Meet Company. And we will give you a more comprehensive run through of the year and more details on 2022 and beyond, and a little more sort of forward strategy. So this really is a trading update and a chance to check in with you guys more than anything else. Hopefully everyone can see the slides on the screen. Tim and I, between us, are going to just take you through a little summary and then we'll turn to the floor for questions. We have 4 questions submitted. Please do submit your questions as we are talking. We'll try and answer as many as we can. So please take the time to get those questions in. So reflecting on the year, I think, it's been a year of progress. The 2020 year was a COVID year. And I think for everyone, it was an unusual year. And on the one hand, it accelerated some of our performance and activity. And on the other hand, it presented some fairly major challenges, as it did with everything from people and culture through to supply chain and customer service. This year has let us see some really solid progress. We are building a unique sleep wellness business. We're trying to build a business of size and strength and sustainability, a business which can be long-term cash generative whilst growing. So to that end, the main sort of 4 areas we've been looking at, or the main 3 areas we look at this year, is around product development. So to broaden our range from just mattresses into a number of other categories, we're now working in around 6 categories, depends slightly how you define categories, but everything from bed frames and filled products such as pillows through to linens and sheets, and an increasing range of what we term as sleep accessories. So that's things such as, weighted blankets, CBD oils, candles, lights, or water bottles, pre-dinner wine, pre-sleep wind down routines. It's significant for us, mainly as it really differentiates us from our competition. It starts to build the ability to create higher customer repeat levels over time. Clearly, that won't come immediately because we've only just started. So most of our customers are new customers at the moment, and generate some proper brand loyalty, which gives us a more efficient way of marketing our business. The first category we expanded into, beyond the very core of mattresses with a few sort of protectors and pillows, was bed frames. We expanded into bed frames, or we started our expansion almost 3 years ago now. Bed frames are now a meaningful business in their own right. It takes time to build your presence in a new category, everything from building your time on Google search through to establishing products and repeat rate, and generally just having customers enjoy the products and tell other people about the customers takes time. So generally we look to 2 to 3 years to understand whether a category is established. Bed frames is now established, other categories will follow. The brand we have built is a premium brand on perceptions. So most of our thinking, certainly on the marketing side, is around ensuring we differentiate as a premium brand. We're not a pilot high, sell it cheap brand. One of our competitors, Emma, is very much about giving you the cheapest mattress it can. That's not where we are. We are seeking to build a premium brand and sustain ongoing both price and margin premiums from the back of that. Our premium ranges are significant now in our business, so I think they represent around 40% of the business. That's across premium bed frames, premium mattresses, and even into premium sort of add-ons, as we describe them, things like protectors. Particularly in the mattresses, we are award-winning, so the best 2 mattresses in the country, according to Which, are Eve mattresses, and the best mattress in France, according to Cuchoisier, which is the French version of Which, is an Eve mattress, is our premium hybrid. So really pleased there, and that in the long term gives us much more pricing strength. Sleep wellness and gifting, as I touched on earlier, is expanding. We're now at 50 SKUs, so individual units across about 8 or 9 ranges. This is very much around moving from being a single single product focused e-commerce business to being a sleep retailer. So you'll see across that range, there are products that we have designed and developed in-house. There's products we've designed and developed with partners. Where we license these brands to a partner who may have more expertise, for example, CBD. And there's products that we have retailed and brought in where we feel there is a strong brand, where the brand that we are bringing in has more weight and credibility in the category than Eve can bring. An example of that would be Rescue Remedy. This is really important for us. Eve's plan is to become a sleep wellness retailer and genuinely offer you all the things you need to help you sleep well, not a single product category. So we are aiming to become much more, as I would describe it, the John Lewis of sleep than we are a single product category. And attachment rates are increasing, so it's very difficult to understand what the right numbers to look at, because as you grow a business, inherently you have more new customers, so it takes time for those customers to repeat. So looking at repeat rate can be confusing, because if repeat rate is going up too rapidly, your business is often shrinking, so it's a little difficult to pick through repeat rate. Attachment rate is a more useful measure. So this looks at how many people are adding other products to their basket when they're buying a mattress, and is a core measure of the fact we are offering products that widen the sleep offering beyond just the mattress. And attachment rates are going pleasingly in the right direction. A lot of work to come across categories. The French business, we have spent the past year rebuilding it. I mean, the rebuild started in May, so we're 9 months into rebuild. It's a significant overhaul of the business, all the way from the business model and the logistics, the warehousing, the product set, through to the brand proposition and communication. Our 2-year plan started in May. Our first communication started in May. We're 9 months in. It will take time. The French market is a different market to the UK. It is much more focused on the high street. So the progress to e-commerce is behind where the UK is. It's on exactly the same trajectory, but it is probably 3 to 4 years behind where the UK is. So if you want to wind Eve UK back 3 to 4 years. And in a similar way to the UK, it is becoming a very aggressively competitive market. We have competitors spending in the market. That does 2 things. On the one hand, it creates a category, which is useful for us and creates awareness that direct-to-consumer mattresses, bedding, and ongoing sleep is a category. But on the flip side, it means there is a very large share of voice or share of spend going through competitors, which in the short term drives competitive steal. We had exactly this dynamic in the UK in 2019. When we launched our sloth campaign in 2019, we all had a moment of worry because we didn't see the dynamic we'd expect from such a strong advertising campaign. As we've seen over time, as the market settles down, the campaign is incredibly strong and the work comes through. So France will take time. We have some really good early signs of improvement. The first thing we look at is our conversion rate, which is how many people who land on the website go on to buy a product, which is a sign of the strength of your products, the strength of your brand and your price proposition. That is stepping forward materially over the last quarter to half. The next thing we will look for is to see that turn into both traffic growth, so people coming to the website, and revenue growth. And then the biggest challenge, I think, facing Eve, and indeed facing, I think, every single business. I obviously don't work in every business, but I think every single business over the past, 2 years, quite frankly, with COVID and supply chain. We took a decision earlier this year to increase our stock holding. So part of the reduction in our cash reserves is to do with an increased investment in stock. This is protected against supply chain volatility, which has been driven fundamentally by COVID, but the fallout of COVID, everything from global logistics and the fact that containers were stuck in the wrong part of the world, through to very locally shifts being unable to produce products because they are all off isolating. So the supply chain is much more volatile than we would choose. We've navigated this very well. As I said, increasing our stock holding. We've kept our average delivery lead times for large items below 10 days, where a number of our competitors, and particularly some of our big competitors, so whilst we look at Emma and Simba a lot, actually the biggest competitors we have are people like IKEA and John Lewis and Dreams and Benson's Beds. many of most businesses have been working on 6 to 8 week lead times, and certainly the furniture competitors have been on 3 or 4 month lead times. We've maintained all of our lead times for large items, which is where the challenges really sit, below 10 days, and suffered very, very few out of stocks. In fact, no out of stocks on any of our core products over the past 6 months. So very pleased with that move, although I understand that then creates investor questions around cash. And then most recently, we have had a challenging Christmas period. So we had a little bit of a perfect storm. I think people may have seen me describe it as such. If anyone's reading Trustpilot reviews, it is me that responds. So you'll recognise some of this language if you're doing that. Combination of factors. Partly, there's been a big move around of people after the sort of pandemic lockdown eased, which meant a lot of our team changed over, which meant we had new people training up and a change in team. Partly, COVID really challenged the whole delivery network. So all of our delivery drivers and our delivery partners, so DX is our main partner for big deliveries, they suffered huge amounts of shortage in staff, which meant that they are trying to stick to their agreements with us in terms of delivery lead times and stick to customer servicing, but were inevitably failing because they were trying to do too much with too little. And that goes all the way back to our production facility, where they were having people out with supply with isolation, or our warehousing. So a bit of a combination there. And then on our own end, we internally suffered with a little bit of staff illness and a couple of planned outages, which you can't sort of wind back on people who've got planned events. But it meant we were short-staffed in our own customer service team at a time when customer service became quite challenging, all combined with a very strong start to January, which I'll allude to. So January is up year on year, and is following a great trajectory, but that brings with it ever more challenges in customer service. So it's a short-term blip. We're already seeing service improve. I mean, service in the last week was a good 20% up on the previous week. So last week we were delivering over 95% of all products exactly when we said we would, whereas the previous week it was below that. We anticipate that will continue. I think everyone can see what's happening with the Omicron data, and case rates are dropping. This is hugely helpful for us. The fewer people isolating and the fewer people with Omicron, the easier it is for our supply chain. So this is a short-term blip, and it will be recovered over February. As you spoke to, I think, in the trading update, indeed we did, we are targeting break-even in the UK and Ireland in 2022 with a return to revenue growth in France. And the important message for this is we are trying to build a sustainable business. We're trying to build a growing business. So it is always a balance in a business, how much you invest for growth. There is little point in us hitting profitability for 1 year if the business is then declining, because that profitability becomes a 1 year profitability and the business declines. So we need to balance a continually growing top line with profitability to create an ongoing, growing cash generative business, not just a 1 year profitability.
So we've drawn out here some of the key numbers that are in the trading update. Obviously, there'll be a lot more detail when the annual report comes out in mid-March. So this is the level of detail that we're able to share at the moment. So you can see there, and as I said in the trading update, group revenue was 26.6 million last year. So that's a 6% increase on 2020. Which is, some of the years quite tough comparables. We were in lockdown for a lot more of 2020, I think, than we were 2021, and high street stores were closed in 2020. So to have continued to grow on what for last year, some of it was almost felt like post-COVID. That's quite pleasing. 11% growth on our pre-COVID group revenue there, which was 23.9 million in 2019. UK and Ireland presents a slightly stronger picture, so 10% growth on the revenue against 2020 and a 22% growth against 2019. The underlying EBITDA loss there, 2.9 million in 2021, so that's a widening of the loss of £900,000 against 2020. The difference there, as I think it says in the trading update, and we've already sort of covered, is the difference in marketing investment. So we spent a lot less on marketing in 2020, and particularly in France. And whilst France saw reasonably healthy revenue on the back of COVID and lockdowns, the impact of not investing in the marketing was seen in 2021. So as Cheryl's mentioned, for next year, we are definitely driving for growth in France. We split the losses there, the EBITDA loss between H1 and H2, and you can see that H2 is considerably less than H1. So that gives us a good platform for 2022. And net cash at the end of the year there, so we had 4.5 million, which is down from 8.3. As the trading update says, the most of the cash outflow was in the first half of the year, and a big chunk of that was us investing in our inventory so we could hold more stock, which has paid dividends, as it were, throughout the year, where we've been able to maintain maintain supply to customers and ride out any disruption in the supply chain, either through our suppliers having constraints in being able to access raw materials or having constraints in their staffing. So, as I said, a chunk of that cash has increased our stock levels, and so at the end of the year, we were certainly sitting on more stock than we had at the beginning. That's all the numbers that we've got for you right now, but when the annual report comes out, obviously there'll be a lot more, and then we'll have another follow-up call with investors, and we can talk in more detail about the figures.
And just a reminder of where we are on our growth plan. And as I said, this is a plan that really kicked off sort of early last year, early 2021. I keep forgetting what year we're in. So we are sort of 10 months into what's built as a 2-year plan. First priority and the biggest priority, as you can see from the numbers, and the thing we will always protect, is to sustain UK growth. When we wrote this plan, I don't think we definitely didn't understand quite what COVID had done to 2020. And I think sustaining UK growth to the tune of 10% against the 2020 baseline has been an absolutely remarkable performance, which I think is not reflected across most of e-commerce. Certainly the data we are seeing is that e-commerce has been in decline for most other businesses on an incredibly strong COVID year. So very pleased to see that we are maintaining that growth, which we're doing with the combination of the products and the customer experience and the brand, and increasingly strong data insight that allows us to invest more efficiently our performance marketing, our digital marketing. Accelerating France, as I say, we kicked this off in May. It will take time to come through. We have sort of ticked off a lot of the things we needed to do, from the logistics and the warehousing through to the new brand positioning and brand advertising. We've got a lot more still to do. So I would say we're 9 months into the 2-year plan here. There is some fundamentals to come, I think, particularly around our product set. We are looking at our product range particularly, and looking at the Cush Fraisier, which is the French version of Which, and how we make sure we leverage that more effectively. Lots more to come in France over the next year. Entering new markets. So this is more about using the platform we've built in Shopify. So people probably won't remember, because you don't live day to day in the business as I do, that we spent 2019 and early 2020 re-platforming the business to a platform called Shopify, which is a universal third-party platform. We historically had built our digital platform in-house. Shopify allows us to open new satellite markets at very, very low or zero entry and also exit costs. So building the capability, and this, look, these things are not going to add 50% of revenue to the business, but they are material additions and material ways of further accelerating the use of the assets we have and that we invest in, both people and creative. The first market we've accelerated in is Ireland, and I can't remember the Ireland figures, but it's remarkably up year on year. Ireland has been an interesting, useful test for us, and it's given the confidence for us to know not only what is easy, but also which bits we need to get right. And we'll be looking at our next satellite market next year. As I said, these are not life-changing, but it does continuously grow the return on investment of our overhead more than anything else. And then building operations for efficient scale. I mean, I've talked a fair bit about all the work we've done in France. We have and are doing a significant amount over this year, and we have done over last year with our partners, particularly our logistics partners and delivery, to improve our delivery experience and our customer experience. And a key part of all of this actually is building the management team capability to really support the business growth. And I hope most people have seen the board appointments we've made over the year. So Masood, who's the VP supply chain, I think, from Zalando. I never can remember his title, but he's a very, very experienced board member and is hugely powerful in helping us with our operational questions. And then from memory, from May, June, Mike Lloyd joined the board, who's a hugely experienced commercial operator, having held a number of senior commercial roles, and before that, acting as a consultant for Oliver Wyman. He is an absolute powerhouse of commercial and financial knowledge and strategy, and has had a huge impact already on the business over the past 6 months. That focus on building talent goes right through the business. We've recently appointed a data director who has joined us from John Lewis, and we have a number of other appointments in our eyes to continue building the capability, combined with fantastic development of our own team. We have an incredible team here at Eve. I think the thing that's surprising more than anything else is quite seeing how much and what great work this team of, and we are 50 people, that's all we are, a team of 50 people can deliver, and the impact we can have on the industry and on the business. So it's really, really strong from a people point of view. That doesn't mean it hasn't been challenging. I think everyone's faced people challenges over COVID, but we've ridden it through fairly well.
So I think that's the end of the slides.
Cheryl, Tim, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated in the top right-hand corner of your screen. But just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. We received a number of pre-submitted questions from investors, and I want to start off the Q&A session with these. The first one reads as follows. What is in the pipeline for Eve in 2022? And will we see profitability from 22 onwards? Are there any new products in the foreseeable future that may be scalable in terms of sales via multiple outlets to impact the potential growth of Eve?
Yeah, I'll happily take that one. So obviously, I can't share our total new product development pipeline for Eve 22, but I can reassure you, and I hope the way I've spoken has reassured people, that our focus is about sustainable profitability. So I think I said a year ago, if we stopped investing, we could be profitable. That still stands. But if we did that, we'd be profitable for a very, very short period of time. And I don't think any investors around this table want to see a declining but profitable business. We are here to build a growing and cash generative profitable business, and that's absolutely our priority, which is why we will continue to invest where there is growth and a longer term payback than short term profitability. In terms of products and pipeline, as I said, we'll continue to expand in sleep wellness. We'll continue to expand on the core ranges we have in front of us. We are doing a lot of work at the moment on what our digital experience is. So I think you will see us talk more to the digital product expansion over the next 6 to 9 months, as opposed to the pure physical product expansion. In terms of scalability, the product the two products I think which have most surprised us in their performance over the past sort of 12 months. One is the spindle bed frame. If anyone goes on our site, it's a fabulous wooden bed frame. It's a very, very premium bed frame. It sells incredibly well. Everyone's very keen on it. So I think that's a bed frame we'll be looking at and saying, can we work with partners on that? And then sort of more fundamental, more sort of obviously the sleepaway range. We very consciously recognize that one thing that people have not been able to do during COVID was to spend time at each other's homes, and that they would be very keen to spend time at each other's homes as soon as they could. We did a fair bit of research to understand that, and what we saw was actually people's number one priority was visiting friends and family and staying over, which makes an awful lot of sense ahead of going to the pub, which is part of the reason we developed the sleepaway range. We also recognise in the market there isn't a high quality packaway mattress to have in home when you have guests. That range is absolutely sold like hotcakes. People may have noticed we sometimes struggle to keep it in stock because, as with any new range, it's quite hard to forecast quite how well it's going to sell. And so that is a range that certainly we are looking at partners with, because it feels a very scalable range. It's a very easy thing for people to stock. It's a nice size product. Beyond that, our core mattresses. So our core business is mattresses is what we do absolutely brilliantly, and there is still lots of room to develop partnerships with our core mattresses.
That's great. Just turning to the next question. Are there any plans to make and highlight Eve as environmentally friendly as possible? Some competitors are planting trees via a scheme, for example.
Yes, I've seen the competitor planting a tree via a scheme, which is very interesting. I'll not make any comment on the rest of their commercial practices and how well behaved and nice they are as a business. But at least they're planting trees. That's good. We focus on our sustainability. Our number one priority isn't anything sort of scammy like planting a tree. our number one priority is to make sure that every mattress that gets returned to us is recycled and or reused, so it lives in a circular economy. We do that. So 100% of the mattresses that come back to us, we recycle and we reuse. And that includes not only our own mattresses, but any mattress that we pick up from a customer who's bought an Eve mattress, their previous mattress. So that's our number one, because the biggest impact we have on the carbon economy is mattresses going to landfill. It's the biggest problem in landfill. Our next focus is very much on sustainability of packaging, and we have a lot of work going live on that. We have to use a lot of plastic to hold our mattresses tight, and there's a lot of work going on making sure that is recycled and recyclable, and that will be coming through. We've done a lot of work on our box packaging as well. Sustainability isn't something that I think people should be using to shout about. It's like shouting about being, I don't know, nice to your people. Fundamentally, sustainability is absolutely what we should all be doing every day. So I would never be using it as a front and center argument, because you should buy our products because they're fabulous and they'll help you sleep well. And that's the impact we're trying to have on society. Of course, you should expect them to be sustainable. That's our job as an ethical and sensible company.
Thank you for that. Are there any resources to introduce a telephone hotline to smooth the customers who are having a delivery problem?
Yeah, let me speak a little bit about phone lines. So we have had a phone line at Eve always. And the challenge with a phone line is that you need an awful lot of manpower to man a phone line. And what happens is most customers don't really want to speak to a human being. So the vast majority of customers would like a quick answer to their question, ideally typed. So actually phone line becomes a blocker for the vast majority of customers. This is kind of not what people see, but it's what we know because we researched, spent a lot of time talking to our customers. So the choice is to either man a phone line or to man alternative live channels. We took the decision towards the end of Q3 to test manning a live chat rather than a phone line to understand A, what was customer feedback, and B, could that increase our ability to answer more customers more quickly? Because simply one customer service agent can manage 4 or 5 live chats at once, where they can obviously only have one phone call at once. Feedback was really positive, so we were able to answer around 4 times as many live chats. Customers found it much, much better, and we always offer a callback. So any customer who came in a live chat and was struggling or wanted us to call back, we would call back. It was all going absolutely hunky-dory, and the plans were very much to expand that, and the plans are very much to expand that. Obviously, as I alluded to in the beginning of the presentation, we have been hit with this perfect storm of COVID, which means right now our number one priority is solving customer problems. Any time spent on a live channel is time not spent solving a customer problem. And what we find is when customer problems escalate, they then fill the live channel by chasing the problem. So it's a bit like phoning your GP constantly to ask him what he's doing about your illness rather than letting him solve your illness. So turning off the live channel, which we have had to do, and it's not what we'd ever choose to do, but we have had to do because of this perfect storm, has been essential to allow us to get back on top of the volume of requests that we have coming in. That live channel is back on. We will seek to and are seeking to expand the exposure of that live channel over time. It will just take a little bit of time as we navigate coming out of COVID, delivery and customer service improving, and rebuilding our own customer service team post this period of perfect storm and retraining them.
Thank you. The next question reads as follows. What is the rationale behind changing the trial period to 365 days? Is this not also opening up the business to an unorthodox customer abusing the 365-day trial period so they can use a mattress and then return it?
Yeah, that's a great question. So I think in one question you've managed, whoever wrote that, you've managed to succinctly distill probably a year and a half's conversation in the business. So well done. The business has always had a 100-day free trial as part of the core promise of Eve, and indeed most of the direct-to-consumer mattress companies. There is one competitor in the UK, a business called Nectar, that offers 365 days trial, which is an American company and a pretty solidly profitable company in the UK. Has just taken additional funding. Over COVID, when COVID initially struck, we immediately took a step back as a team and said, what do our customers need? How can we help our customers who are now facing being locked down and all the challenges that go with that? And I think if people can reflect, it was quite a difficult time. People didn't quite know whether they were going to keep their jobs. And we said, well, the number one priority is that they shouldn't have to worry about returning their mattress. So we extended the trial period to 200 days, which we did sort of on the turn of a sixpence. I think we did it from discussion to execution in less than a week, which was remarkable given we'd all just moved to work remotely. All of our competitors followed immediately. We communicate that happened in May 2020, and we did that for around 4 months. We observed that there was no change in the return rates on 200 days versus 100 days. But we returned to 100 days because we wanted to understand the difference between 200 days and 100 days. Because there is slight the financial anomalies in carrying a 200-day liability rather than a 100-day liability. We've now had time to see all the data, so the impact of being on 200 days and on 100 days, and looked at the difference that has on customer perceptions. And we've also tested with research the impact of offering a 1-year free trial. What we can see in research is the impact in intention to in interest in Eve. So we've asked customers, what do you prefer? Their preference is 3 times for 1 year than it is for 100 days. Having looked at the data from the 200 days, we also saw that period of time, our conversion rate was significantly stronger and our return on investment in marketing was significantly stronger. We've also done some on-site testing, and we observed that customers, the trial period is an area of fascination for them on the site. So these 3 data points together suggest that the trial period is a potential differentiator for Eve. Now then, last time we went to 200 days, our competitors followed. What we also observe is our return rates, having done an awful lot of work on our product, our return rates have dropped markedly over the past 2 years, and they've probably dropped something like 20%, thanks to huge amounts of work here at the team. Which means we can afford to offer a longer return period on the basis we have evidence that it has very little impact on return rate. And even if it did have a marginal impact, our return rates are low enough that the cost offsets the benefit significantly. We don't believe our competitors can necessarily do the same. We certainly know one of our competitors has a significantly higher return rate than we do and works on significantly lower product margins than we do. So we believe offering a 1-year return rate is a strong differentiator in the market. We believe it leads the market. We will go front foot forward on it. I think if competitors choose to follow, and they may, the most important thing is we're first to market, and the second most important thing is we can do this more efficiently and more powerfully than competitors. And our evidence suggests that consumers will react very positively to this. There will be some consumers who are clever enough to use it to change the mattress every year. Quite frankly, the idea of having to focus on changing your mattress every year is so far out of most consumers' desires when they're busy just living their lives. We think it's highly unlikely that will be a pattern we see in any great scale, but we have modelled the impact of that and we're very comfortable with it.
Perfect. Just turning to the final pre-submitted question. With the turnaround strategy completed ahead of schedule, why is Eve not showing a profit? Are costs still too high? Are products not being marked up enough? The business needs to be profitable to survive. Hence, what are management's view on this?
Well, we've said in the trading update that for 2022 we are targeting profitability in the UK and Ireland. We've also talked about the ongoing marketing strategy for France to continue to grow the revenue there. So we can't grow the revenue in France without investing in our marketing. So we're very conscious of our P&L, and the first step is for 2022 to achieve profitability in the UK and Ireland.
Yeah, I'll just add to that. I think a lot of people have done the rough maths on Eve, and you can look at the same maths on Simba if you go out through Simba's accounts. And broadly, once you are growing and above around a 30 million revenue as a business, sustainable profitability comes within sight. That is the sort of scale we need to get to, and that's what we're trying to get to as a team. As I said earlier, the most important thing for us is not just profitability. It's not one week, 1 month, 1 quarter, 1 year of profitability. That is of little value in the long-term business, and we're here to build a long-term business. It is sustainable profitability. We do have months and quarters when we are profitable in the year, but there's not a lot of point shouting about them, because the question we have is, can this business grow and deliver cash in the long term? And it absolutely can.
Thank you very much. That concludes the pre-submitted questions. As you can see, we've received a number of questions throughout today's presentation, and thank you to all the investors for submitting their questions. Could I ask you to read out the questions and give responses where it's appropriate for you to do so, and I'll pick up from you guys at the end.
Okay. Yeah, so the first question is from Glenn. Thank you, Glenn. So last year you received a takeover merger approach. Have you received any other potential offers or propositions? I just want to clarify the facts here. So in 2019, we had a conversation with Simba. We approached Simba discuss whether there'd be value in bringing our businesses together. Very open to what that might look like. So it wasn't a takeover merger approach. It was a open conversation between two CEOs. We concluded, well, both parties concluded that it wasn't the right thing to progress with, so we didn't. So that was 3 years ago. No, it wasn't last year. We have had no other offers or positions since then.
There's a question about new products. What products we're expecting in 2022? I think we picked up on that already. Yeah. Do we consider the share price reflects the value of the company? No, absolutely not. I think if we look at the change in our investor base over the past 2 or 3 years, right now we've probably got 80% of our shares are held by retail investors. 3 years ago, 80% were held by institutions. So that shift and the strong retail investor base means there's a lot of volatility in our share price. What we would like to do this year is have more presentations, more communication with investors, and we would expect that as we can talk you through our performance for the year and our plans, that will put more information in the hands of investors so that you'll be able to make decisions and have more visibility about how the company's performing, which we would certainly expect would mean that our share price would more accurately reflect the value of the business.
Let me just scan through David's question. Bear with me, guys. It's a very long question. Because the question is around whether or not we will remain independent. The current share price. So David says the current share price weakness leaves Eve wide open to a predator. I think the market's looking for a value trigger such as profitability. Can the board really double down on this objective? As I think the positive focus will bring to the company will solve the share price issue. Guys, I think all we can do is run a business for long-term profitability, and that's what we are doing. I think you can see, as Tim alluded to, the volatility. If I reflect on my time at Eve, when I took over, the share price was 1.2p. And I think yesterday, just before the trading update, it was 3.5p. So that was 3x the share price. And there have been times when the share price has been 7 pence. So that's 6x the share price when I took over. It's a very volatile share. What we cannot do is get distracted by trying to manage a share price. It's not what we're here to do. We're here to build a strong, sustainable, profitable business. That will then generate a strong share price. We are all shareholders. We're all significant shareholders in this business. Our incentives are entirely aligned with your own. All of our senior leadership team and our middle management are also shareholders in this business. So we all have the same objective, which is to run a strong, profitable business, which will in turn generate a stronger share price.
The next question. Last Investor Meet presentation, we were told that you could have shown a profit if you chose to do so. However, you said that you were aiming for sustainable profitability in 2022. Now this has changed to break even in 2022, and it's only for UK and Ireland. What changed? What went wrong? Also, has the cash been considerably reduced? Do you still have enough cash to get to profitability without a raise? So dealing with the cash question first, we've said we had £4.5 million of cash in the bank at the end of the year. The research note that our broker ThinkCap's put out today shows that we should achieve 29 million turnover this year and about £1.6 million loss at the EBITDA level. That £1.6 million EBITDA loss will more or less translate to cash burn. So that would leave us with about £3 million in the bank at the end of the year. So we have plenty of cash to cover our plans for this year. We've not yet put together detailed forecasts for the following year, but we're certainly comfortable that we have sufficient cash for the next 12 months and beyond.
Yeah, I think I'd build on that. So, what we were very clear in our investor meeting was to talk about towards profitability. So we always had an intention to make sure we got one market strong and sustainably profitable and one market in high growth. If that does not come through, we will take decisions on a high growth market. We will ensure that we have a sensible loss this year, which is in line with our forecast, and we will ensure that UK reaches break even. It's a journey. We're exactly where we said we would be. It is important to note that the trajectory, some of the cash burn and some of the profitability sort of swung between 2021 and 2020 due to COVID. So you kind of need to sort of slightly smooth the line rather than seeing it as bumpy. Kevin, so the share price has halved since I came to power. Thank you for your language, Kevin. The share price hasn't halved since I came to power. The share price has nearly trebled. Cash is concerning. I think Tim has just talked to that. Why can't we show a profit with 26 million turnover? And as I alluded to earlier, we could show a profit with 26 million turnover for 1 year, and then the business would begin to decline. I don't think a declining business with 1 year of profitability would do what we want it to do. I don't think any of us are there. Should we think about a new CEO? Can you reassure investors? Well, I'm hoping this is reassuring.
Question here about John Lewis. Have you tried listing with them? Their premium brand seems to align very well with Eve Sleep.
So we've had lots of conversations with John Lewis. John Lewis, unfortunately, are a very, very expensive partner to work with. The way they are structured means that we can't make commercials viable for the business. So we have, a number of times we talked to them, and each time we have decided that it's not right for us and for them. They are bizarrely a fairly small player in the mattress industry, so the volume through John Lewis is not significant. And where we find partners, particularly big partners, they need to be real focus for us, and there wouldn't have been, or there isn't the commercial opportunity in John Lewis that we'd need to make it viable.
Will another fundraise be necessary? We've talked about the cash, so we've absolutely got enough cash to see us through for the next 12 months. Investors are welcome to draw their own trajectories from our loss last year of 2.9 and our plans for this year of 1.6. So, as I said, for the next 12 months, we're very comfortable we've got sufficient cash.
Is there a 3 to 5 year plan that can be shared with our shareholders? Oh, sorry, I just lost my. There isn't in front of us now. I mean, we have a 3 to 5 year plan, but it can't be shared with shareholders. To answer the question right now, we will talk in our annual results, which, to remind myself, are 24th of March. A little more about the forward plan. Yeah, I think that's the best way to answer that, really.
Yeah. When we missed it, for sleep gifts like CBD oils and other Eve branded gifts, will there be a wider online push to list in retailers such as Boots?
Yeah, so part of the reason we've done, particularly CBD is a great example, with a partner, so we've done it with a fab company called Sana, is that they have their own sales and marketing team that have relationships with wellness retailers. So they will be driving that for us. Managing retail partners and driving those sales requires particular skills and particular relationships. We are an e-commerce focused business, so our sort of manpower in that space is relatively limited, which is why we work with partners.
Question about social media. Why is Eve Sleep not using social media to interact with potential or current customers?
So we, as you've seen, the marketing efficiency has improved dramatically. And one of the things you do to improve marketing efficiency is you stop using channels which aren't generating sales, but which are very nice to have. Social media is a fabulous example of a channel which can become very nice to have if you don't have a clear strategy and a clear way of generating sales from it. It had become that at Eve. So there's an extensive team creating lots of content, none of which was driving sales, and all of which was talking to customers of Eve who are already customers of Eve, and we're trying to grow. We are looking this year very much at how we develop that channel and how we move forwards, particularly now we have a much stronger positioning in sleep wellness, which allows us to unlock potentially influencers as a category. Influencers don't really sell mattresses. Very few people buy a mattress because they see someone stroking it on an Instagram post. It's not really why you buy your mattress. It's a much more considered purchase than that, and it's less of a lifestyle purchase. The move into sleep wellness allows us to reach a very different set of influencers who sit in wellness. So we will be exploring that over the next year.
In July, you were expecting H2 revenue above H1, given business is H2 weighted. However, H2 revenue was 12.7 versus 13.9 for H1. Any particular driver for this? I did actually, I saw that question pop up earlier and I went back to reread the trading update we put out after H1. I think we said that we were expecting H2 to be in line with expectations. The two halves of the year are very different. As you quite rightly say there, H2 includes Black Friday and Christmas. However, although our sales orders will be very high in the post-Christmas period, and that's like literally 8 days, the revenue that we report is revenue that we have delivered to customers. So we can't, and it goes against accounting rules, as some people I'm sure are well aware, we can't report revenue until we've actually delivered it to customers. So the post-Christmas revenue will feature in the January accounts. That's the same every year. That doesn't change. So our approach hasn't adjusted there. Looking back also at 2020, and when we were projecting for 2021, it was incredibly difficult to foresee how COVID and post-COVID, if there was to be such a thing as post-COVID in 21, would actually impact our revenue. Thinking back to the first half of 2020, in the first quarter, there was noise about COVID starting to happen, and people's spending habits were starting to change, and people were starting to spend less. As we got towards the end of Q2 in 2020, stores were closed, e-commerce businesses were benefiting a lot. Towards the end of 2020, stores were reopening. So when we were planning and trying to forecast 2021, it was very difficult to sort of gaze into that crystal ball and try and figure out what might happen.
Very lumpy baseline.
Yes.
Certainly.
Yeah. Paul has asked, why is reduction in marketing spend a good thing?
Pure reduction in marketing expense is not a good thing, because you need I don't tend to use the phrase expensive marketing investment. You only invest marketing to drive sales. Clearly, you want to be driving more sales, and inherently more investment tends to drive more sales. What is a good thing is a reduction in the percentage of revenue that is spent on marketing, so an increasing efficiency in your marketing spend. So I think what we've spoken to in the trading update is revenue growth of 11% achieved on a 40% lower marketing spend. That is a really good thing, because it shows that the work we've done to get the marketing working hard has worked, which is what gives us confidence. That means we can now accelerate that spend over this year, which is what we have in front of us, to drive the revenue growth we have in our forecast. So great question. Yes. Good point.
A couple of questions here I think we've already covered. So talking about 2022 and also talking about the 365-day trial. Question about the sloth. Will the sloth continue to be the face of Eve?
Well, who knows? I think if I gave that away, I'd be giving away all sorts of trade secrets. So look, the sloth is and has been fabulous. She, we try to non-gender him, has done great work, delivering fantastic ROIs in marketing. You can see in France, you may have seen in France, we very recently launched the Monsieur Le Coq, who is a monsieur, which is the French version of the sloth, and is slightly more sort of stylized and a bit more sort of all about the morning. Who's also going great guns. So look, marketing, creative vehicles and consistency of creative vehicles is incredibly powerful for making your marketing dollars work hard for you, because it's all additive. And the sloth is a fabulous mechanic, because it runs right across everything we do, and gives us a way to tie the brand together and make the brand recognizable beyond just the sort of yellow border, which is our other key asset.
Andrew's asked about stock levels. Will they remain as high if supply chain disruption decreases over the year? We will react as we need to. We don't foresee supply chain disruption decreasing this year. I'm sure there will continue to be lots of volatility. And so whilst that remains, yes, we will try and hold the stock that we need to smooth out any disruption. And we will continue to review that position as the demands dictate.
There's a question from Andrew around higher education, and should we be working with higher education and partnering with student beans or uni days to offer students with discounts? And beside this, maybe we should work with higher education to emphasise students and engage them on how important sleep wellness is. Great question. The challenge we have in marketing is you've only got so many marketing dollars, and you have to choose your target audience. And in a quite mercenary fashion, and it is mercenary, we choose the target audience with the most money that spend the most on mattresses and bedding and bedrooms, actually, and sleep, quite frankly. And that audience is people whose sleep is most challenged. And with all the best will in the world to students, the people whose sleep is most challenged are people who are in what we describe as peak family. So people with children, people running a busy household, maybe working in full-time jobs. They happen to also be the people who spend the most on beds, bedrooms, and their sleep. They're most likely to have more than one bedroom to kit out, and therefore they become the financially most viable audience. It doesn't mean we shouldn't speak to students, and I think in a world where we have a greater marketing investment, once you've kind of nailed one audience, you start to move out to other audiences, and certainly students would be a further out audience for us. But for the moment, they're not the most efficient audience for us to spend our sort of marketing dollars with.
I have a daughter at university. If anybody watching has a daughter, a son or daughter at university, going to university, I can recommend our mattress topper.
There we go.
It's a great compliment to a crappy student bed. Question about cash and share placing, which I think we've already addressed. Question from Martin. Have we looked into implementing an option for customers to get alerts on sold out products as soon as they're back in stock?
Yeah, I mean, absolutely. So in the same way as our marketing dollars have to be prioritised, our tech investment and what we develop has to be prioritised. Back in stock alerts are very much on our tech backlog list, and we prioritise everything in terms of its commercial and its customer experience impact. So we kind of look at the two. They're on our backlog list. As you can probably see at the moment, some of the bigger challenges we have are around making sure that delivery communications are landing correctly and making sure that people are able to understand the right product to purchase and are moving through the purchasing funnel quickly. That's our priority right now, but back in stock alerts are very much on our list. We would far rather, the more important thing is to solve the root issue, which is the work we've done this year, which is around keeping products in stock. So the commercial loss from products out of stock is very, very low, which means the commercial upside of back in stock emails and the investment in that is much less.
Andrew's asked about Trustpilot reviews and the fact that 90% of the complaints are relating to problems to do with our delivery partner.
Mm-hmm. Yeah, and I sort of alluded to this. Do we have regular communications with DX? My goodness me. So yes, we talk to DX all day, every day and they are our partner. It is a really challenging time at the moment with COVID, as I'm sure you know. Fundamentally, if you are trying to run a delivery network and you are, third down on your staffing levels, delivering the service that they expect to deliver, we expect to deliver, we're paying them to deliver is really, really hard. And that exposes lots and lots of flaws in stuff that used to work really well. So communications that used to work really well, you'd get a text sent the night before to tell you your mattress is coming, fantastic, and then your mattress comes. Now, it doesn't work because you get a text sent the night before to say your mattress is coming, but in the morning, unfortunately, the driver calls in and he's isolating, so your mattress doesn't come. So you can understand how this very, very high level of isolation and challenge throws up problems, which we then grapple to solve. We are working really hard with DX. It is not a DX problem. It is a fundamental delivery network problem. I was reflecting at Christmas. I think I ordered 40 presents from Amazon, and I think 30 of them came on time, and 5 never turned up, and I had to chase them down. And that's Amazon, which I think we would all say is probably the world's best logistics company.
Question from Andrew. Can we expect Eve to participate in a number of investor presentations and interview events during the year? Yes, absolutely. So we will be, as Charles said earlier, we'll be holding another one when we release our annual results. And I anticipate we will continue to do that throughout the year.
You don't sound as confident now as you were in the last presentation. Goodness me, that's not intentional. So do you have enough cash to get to profitability? Yes, we do. We do. We are managing the business to get to a growing business with sustainable profitability. There is no point not investing the money for growth. There's no point sitting on a pile of cash and doing nothing with it. The money is an investment. It's given to us to invest and therefore to grow the business. That is what we are doing with it.
Has an investor ever suggested a product which we have gone on to sell? I'm not sure they have, but then we do have a great team of people here thinking all day, every day about new products that we should be introducing to the business. So if any investor has suggestions, please do fire them in, and we will pass them over to the product development team.
Would you recommend a merger or take over the Price is Right? I mean, I can't really answer that. There's a million factors in a yes or a no or a maybe. I can't really answer that. I don't know if you could.
No, we would, as the board would be obliged to consider any sensible mergers and consider what would be in the best interest of investors. So all I can say is that it would be done on a case-by-case basis if such a thing were to happen. And
it is important to remind everyone we have a board. So whilst you've got Tim and myself here representing the business today, we have a board, a very, very experienced board of people who work together on the future of the business.
And I think probably the final question here, any thoughts of a share buyback to mop up low price shares? No. We have £4.5 million of cash in the business, and we want to use that to grow the business and to grow it towards profitability. I'll just do quickly the one on film pajamas, and I think then Alessandra will probably return.
Will we move sleep clothing products? Pajamas. Like all of sleep wellness, we will look at it. So yes, it's one of the categories on our list. It's another one of those where we might work with a partner who's more experienced in designing fabulous pajamas than we are. But yes, sleepwear is on our category list. Sorry, a couple more too. Are affiliates still a very successful way to market our products? They are. I mean, affiliates are incredibly powerful for Eve. What is interesting is I think a lot of people don't realise who affiliates are. So I had a fantastic conversation with someone where they went, oh, you shouldn't work with affiliates. It's all cashback and Groupon. And I said, no, absolutely. I totally agree. They said, I just go to the independent and I look at their recommendation for the top 10 mattresses. And when I told them that the independent were one of our biggest affiliates for exactly that, they were really shocked. So affiliates is often publishers doing reviews of products. It often isn't cashback sites and things like that. We find publishers very successful for us. People need to research products and they trust particularly news websites for reviews. And particularly over COVID, when everyone just spent all of their time reading the news all day long, sitting at their desk, desperate for content, we found that publishers, particularly the Daily Mail Group and the Independent, had an amazing impact on the business. And will I buy more shares? I'm not going to answer that.
No, I think we were asked the same question last year. We can't answer that in advance. If we were to tell investors in advance of us buying more shares or to give our intentions, we'd be in full foul of the regulation. So if that happens, then of course we will put out an RNS to inform investors that directors have bought shares. Thank you very much for your questions. We've reached the end of the list.
Yeah, thank you very much to both of you. You've been very generous with your time, and I think you've actually addressed all the questions you can from investors. And of course, the company will review all questions submitted today and will publish responses on the Investor Meet Company platform. Before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Cheryl, could I please ask you for a few closing comments?
Oh, you didn't tee me up for this, Alessandra, so I'm not prepared. A few closing comments. I might just speak a little bit about, we are here to build a business that we're all incredibly proud of. It's incredibly proud of it financially, incredibly proud of it culturally, incredibly proud of it for the impact it has on society and on sleep, on the economy, and incredibly proud of our products and service on a day-to-day basis. Balancing that is what we are here to do. So we will never put the interests of any one party, any one key stakeholder ahead of any others. We will get to profitability with a fantastic business that we are very proud of, that is sustainable and growing, and that's what we're here to do.
Cheryl, Tim, thanks again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of Eve Sleep PLC, we'd like to thank you for attending today's presentation, and good morning to you all.